23 seconds away from the opening bell in New York to kick off a brand new, fresh trading week with equity futures totally unchanged on the S&P 500 after a marginal week of gains on the S&P of about 0.8% or so off the back of pretty tremendous bank earnings on Wall Street. More bank earnings through the week. That's the opening bell. Switch on the board and get to the bond market. Here's a move for you. Yields higher again. 356 on a 10-year, up 5 basis points, up more so at the front end of the curve on a 2-year yield off the back of Governor Waller's comments on Fridays. Yields up and away. And this morning, some follow-through. Up 5 basis points on a 2-year to 4.15. That means some dollar strength. Euro-dollar backing away. Negative 0.4% after seeing a new intraday high for the year on euro-dollar on Friday. The euro stronger at 110.76. We've backed away since then. Crude backing away as well, a break of 82. 82 right now. We're down about 0.6% on WTI. That's the broader price action, the broader story in the equity market. The opening bell about 30 seconds into the session. We are negative by not even 0.1% on the S&P. One stock to watch at the open, M&T Bank, reporting better than expected Q1 results and net interest income doubling over the past year. Katie Lyons has more. Hey, Katie.
Yeah, John, interesting to see that M&T Bank actually now down a few tenths of a percent at the opening bell after earlier in pre-market trading being up nearly 5%. So quite the turnaround here. As you said, broadly, it was a beat on most metrics. They beat on revenue, net interest income, as you said, helped a better than expected profit with earnings per share coming in at $4.01. The average analyst estimate was for $3.97. Where they came up short, though, is important because it's the metric we have all been watching. Total deposits down 2.7% quarter on quarter to $159 billion. The street was looking for $161 billion. Also noteworthy, provisions for credit losses were higher than anticipated at $120 million. The bank saying that reflects weaker conditions on several loan types. So that could be contributing to the fading optimism we are seeing here, perhaps not giving much relief to a stock that is down 20% year to date and down more than 27% over the last 12 months. It'll be interesting to see what kind of color comes out of the headlines on the earnings call, which begins at 11 a.m. Eastern. But of course, this in some ways setting the tone for the other regional banks that have yet to report. We have Western Alliance due tomorrow, U.S. Bank on Thursday, and the next week the ones I'll really be watching, First Republic as well as PacWest, which of course was downgraded to junk by Fitch on Friday because of concern around deposit outflows. Sean.
First Republic a week from today. Katie, thanks for that. Those names have been hammered. This name as well. Charles Schwab shares under pressure as they announce plans to pause their buyback program. Shonali Basak has more. Hey, Shonali.
Hey, John, listen, you have a deposit base that is down about 30% over at Schwab, and while that's about in line with expectations, you also have Schwab halting share buybacks. Now, listen, the market is already reacting to the stock, and some of the numbers were actually above expectations. The good news within the results here is that net interest income was above expectations. Net new client assets were above expectations. But again, that deposit number is a big deal because that is what lowers the cost of funding. UBS is saying that the cost of funding, the wholesale funding here, comes in above their estimate, but not as ugly as feared. Remember, it's too early to say whether this industry is completely out of the woods, although there are some things within Schwab's numbers that show some green shoots. With that said, the pausing the buybacks is something that comes after pretty historic levels of buybacks for a company like this. So the question about profitability becomes a perennial issue for Schwab as we see some certain business lines certainly under pressure here at the company.
Shonali, you and I are going to talk about the big names tomorrow, no doubt. Bank of America, Goldman, Tuesday onto Wednesday. We're going to be talking about the obvious names as well, like Morgan Stanley. Then there's the regional banks, which Katie Lyons went over. Out of all these names, Shonali, traditionally we just talk about the big ones. What are you focused on this week?
Just check out what a messy week we're looking at ahead of us. Until First Republic on Monday, you can't say the industry is out of the woods because of the big existential questions around it. But even until this week, Thursday is the bulk of the regional banks, and some of those banks, East West Bancorp, potentially Zions that day. These are companies, John, that have outsized real estate, commercial real estate exposure relative to their outstanding loan base. So a lot of questions that we've been wondering about this economy won't be answered until later this week. But earlier in this week, we'll get some answers about just how much Goldman Sachs and Morgan Stanley have picked up some game in the middle of this deposit rush over to the bigger banks with the wealthier clients.
Looking forward to your coverage with us. Shonali Basak there leading the coverage here at Bloomberg TV on some of the major lenders and the regional banks as well. We know the major banks doing fantastically. We saw that from JP on Friday alongside Wales and Citi. A number of analysts raising their price targets on JP Morgan following those results. The team over at Bank of America writing this: while it's easy to discount JPM's strong performance as merely benefiting from the deposit flight at regional banks, this view misses the extremely strong execution at the top. We raise our price target to 158 a share. B of A taking JP Morgan price target to 158 a share. That's the latest on some of the banks. Let's turn to pharma. Merck and Prometheus striking a $10.8 billion deal in one of the largest pharma acquisitions in recent history. Abby has more. Hey, Abby.
Hey, John, and take a look at the shares of Prometheus Biosciences, up nearly 70%, a $114 stock. If you bought it Friday, now closer to $200 for a company that doesn't have any approved drugs. Not so bad for those investors, but what they do have is a strong pipeline of autoimmune drugs, and that's what Merck wants. They want to diversify, so they are paying that $10.8 billion, 75% premium to Friday's close. It really diversifies them away from their traditional focus on oncology, and especially Keytruda. Keytruda in 2024 is estimated to be about 43% of their revenue pie. The next biggest slice of their revenue pie, if you will, is 36% going to more than a dozen drugs. So they really have so much dependence on Keytruda. So if some of those autoimmune drugs of Prometheus Biosciences are approved as is anticipated, it could really help them to, again, soften the dependence on Keytruda. They, of course, did over the last year also acquire Sharing Plow, so they're aware of this issue. That was a $47.1 billion acquisition. Seagen by Pfizer was another one. But to your point, Prometheus, one of the biggest ones around. And then finally, because of Merck's awareness of this issue that they have, it could be one reason, John, that these shares really outperforming over the last year, up 34% relative to the overall sector, about flat, and the S&P 500 down. So they're really managing that dependence risk well at this point.
Abby, thanks for that. That's the latest on pharma. Let's get to tech. It's Bing versus Google. You know this. The AI-driven search wars heating up. The New York Times reporting Microsoft's Bing could replace Google as Samsung's default search service. Shares of Alphabet falling on the back of the report. Ed Ludlow has more. Hey, Ed.
Yeah, that 3% decline in Alphabet, the parent of Google, puts it on track for its biggest drop since early February. The New York Times reporting that about $3 billion of sales are at stake. What we're talking about is the Google search app pre-installed into Samsung devices. Remember that Samsung shipped 261 million units globally last year. In many cases, Samsung handsets come pre-installed with both Alphabet or Google apps and Microsoft apps. And so the consideration here is Bing being offered as the primary choice for search. You see the market's reaction. Remember that search accounts for 57% of Google's or Alphabet's revenue all told across all types of search. It's a market that Google takes more than 90% market share in globally. This is a very specific example and use case that the New York Times is reporting on. And it's all about AI, right? The lure of Microsoft Bing is that it's now got the OpenAI ChatGPT functionality integrated into it. So interesting to see. Google did not comment on the story or the report, John.
Android. Ed, can I just sit on Android just briefly? Does that change the relationship between Samsung and Android at all?
I think this is the question posed by the article the New York Times put out, right? Of those 261 million units shipped last year from Samsung, they all run on Android. And as I said, it's completely common for the Android platform to have pre-installed both Google applications and Microsoft applications. It's certainly a question that I would ask if I were able to put it to Google, what happens next in that relationship. But I think, the common consensus among analysts is that you don't just change your operating system overnight, John.
Google struggling this morning. Ed, thank you, sir. And I agree with you. It's not something that shifts overnight, but you wonder how it will shift in the weeks, months, quarters, years to come. Here's the broader story right now for the equity market. 9 minutes into the session, stocks really not doing much, but there is a move to talk about in the bond market. Yields a little bit higher at the front end by 5 basis points on a 2-year. Let's call it 4.15. We've talked a lot about this tension between the market pricing cuts and the Fed signalling for this year at least anything but. Calvin C. of BNP Paribas says this: if economic conditions worsen, we think the market can price in earlier and more rate cuts. Calvin, I'm pleased to say, joins us right now. Calvin, great to have you with us on the program, sir. So let's start with that line. Is that your base case? More cuts and earlier?
Thanks for having me. Our base case is that the Fed is not going to be cutting rates this year. Our base case is that the cuts won't come until Q1 of next year. However, that being said, when we look at our quantitative data, in particular looking at the re-steepening of the U.S. yield curve, looking at what the options markets are telling us, and looking at one of Powell's favorite indicators, the near-term forward spread, all of these quantitative indicators suggest to us that even though our base case is for no rate cuts this year, it doesn't preclude the markets from pricing in more and earlier rate cuts. In particular, what we think is very important is that the CPI number last week has opened the door for the markets to price in more. Specifically, we think there's an asymmetry around the data going forward, and that is with all this concern and caution around the regional banking issues, we think it will require a long string of strong data for the markets to price in a longer hiking cycle, but it'll only require a few more weak prints for the markets to push the Fed and price in even more cuts.
So you describe an asymmetric situation then, so push that through the bond market. What's the call now for the front end of the yield curve from you and the team?
Our biggest call is on the shape of the U.S. yield curve. We see a quite significant steepening in the curve driven by a rally in the front end. Specifically in 2's, 10's, we're looking at that to get back positive again by the end of the year. And we like the steepening trade because we think it could really benefit from two different scenarios. Either, as just mentioned, the data continue to worsen and the markets price in further rate cuts, in which case we get a bull steepening of the curve driven by a stronger rally in the 2-year. Or we think it could also steepen in bear steepening environments as well. Specifically, despite inflation showing signs of core services topping out, it still remains very high. And the Fed themselves don't forecast inflation getting back down to target until 2025. So for us, we also see a scenario where if these regional banking issues are not nearly as bad and the Fed has acted very cautiously, that the markets could inject more inflation risk premium into the curve, in which case it hurts the 10-year significantly more than the 2-year, in which case the 10-year sells off and we still steepen. So for us, because it's such an elegant trade where it can work in both bull and bear scenarios, one of our strongest views still remains on that steeper curve.
So Calvin, you described two different scenarios that basically lead to the same thing, led by different ends of the curve. Let me ask you this question. Do they lead to the same thing in the FX market?
We think it does. Specifically, as it relates to the US dollar, steepening environments almost always tend to be dollar negative. And a large reason for that is because of how foreign investors hedge their assets in the United States. Specifically, foreign investors tend to own long-end assets in the United States, and they tend to roll hedges in the front end of the curve. So as the curve steepens, especially if it goes back into positive territory, it makes it such that foreign investors get to FX hedge their dollar-denominated securities at a much more attractive level. And when that FX hedging comes in place, it means they're selling dollars, which leads to a weaker US dollar. So to us, a steeper U.S. yield curve is just one of many reasons, including very rich valuation and including a rotation of flow away from the U.S. into the rest of the world, that leads us to believe that the dollar is in the very, very early stages, we think, of a structural weakening trend.
Calvin, super thoughtful stuff. Let's do this again soon. Calvin C there, BNP Paribas, looking for both a steeper yield curve and a weaker dollar. The bond market right now looks like something like this on a 2-year of 5 basis points to 415, the 10-year of 5 basis points to 356. The curve pretty much unchanged at negative 58 basis points. Coming up on this program, Speaker McCarthy at the Stock Exchange. We'll catch up with Bloomberg's Anne-Marie down in Washington alongside Kelly Lights. That's next. This is Bloomberg.
Well, with Wall Street, I want to be very straight and forward with them. We can't continue down the path that we are right now. The CBO says if nothing happens, the trust funds of the highway, Medicare, and Social Security, they're going to get cut based upon the president. He's cutting those programs.
And the president doesn't want to cut them in his budget, though.
What the president is cutting them, because what happens is they go broke in the next 2 years because he increased spending by $5.9 trillion. You can't afford it. And I don't want to do that. I want to save them.
Speaker McCarthy addressing the New York Stock Exchange at the top of the hour. The Republican leader expected to revive the debt limit debate and make his case for spending cuts. Elsewhere, G7 ministers gather in Japan. A senior U.S. State Department official saying the group is united on its message for China, telling reporters on a call, quote, "We want to work with China in those areas where China is prepared to work with us. And we are certainly going to stand up against any coercion, any market manipulation, any efforts to change the status quo in the Taiwan Strait." Team coverage starts right now with Bloomberg's Anne-Marie in Washington alongside Katie Lyons. Now, Katie, let's start with Speaker McCarthy in New York City. What's the focus of this one?
Well, his message to Wall Street, John, is going to be about a responsible debt limit increase, essentially that any increase in the cap needs to have spending cuts along with it. He actually, over the weekend in a preview, teased to his speech, likened it to Ronald Reagan speaking at the NYSE back in 1985 about his economic plan. What is so interesting, though, is that the White House, in countering this in a statement this morning, pointed out that Reagan warned against debt limit brinkmanship. To quote the statement directly, they say there is one responsible solution to the debt limit, addressing it promptly without brinkmanship or hostage taking, as Republicans did 3 times in the last administration and as Presidents Trump and Reagan argued in office. They go on to say that McCarthy is holding the full faith and credit of the United States hostage and that a speech isn't a plan. The plan is really the question here, John, because we do know after reporting last week that the House may be looking at bumping this out a year into 2024, so increasing it for 1 year only. But as far as those spending cuts, there is no consensus yet on what exactly those cuts should look like, what the blueprint is. And that is what we keep hearing from this White House. President Biden saying, if you want to talk about this, you need to bring me a plan first.
AMH, you spoke to Speaker McCarthy in the last couple of weeks. What is the plan?
Well, from the White House, they say, as Kaylee just mentioned, and Biden was asked this over the weekend in the middle of the night at 2:30 a.m. when he landed back in the United States. He said, of course I'll sit down with the speaker, but show me your budget. And what Speaker McCarthy is trying to do is really bring this to the forefront. This is really his opening salvo to the White House yet again to have another in-person meeting. And what he wants to show is he's able to keep his caucus together. He has to make sure that 218 Republicans, whether they're on the far right or moderate Republicans, are able to sign up to this plan. Of course, it's dead on arrival, as Greg Valliere says. No way is it getting to the Senate. But the fact is Speaker McCarthy is able to show that he has his Republican caucus all together on this, then they can go to the White House and say, it's going to be very difficult for you to try to infiltrate this with a clean spending cut because the House has approved this.
One to watch in about 10 minutes' time. Anne-Marie, Kelly Lyons, to the two of you, thank you. Another thing to watch through the week, not just the bank earnings, a whole host of Fed speak lined up before the blackout period at the Federal Reserve. Mike McKee back with us for a little bit more. Hey, Mike.
Hey, John. Well, the question now is not really what they're going to do on May 3rd, unless there's some weird news between now and then. It's what they're going to do after that preoccupies the markets. We do have a lot of Fed speak this week. Not all of it important. Some of it is on different topics. But look out Wednesday for the Beige Book, Austin Goolsbee and John Williams from the New York Fed, Loretta Mester, Raphael Bostic, and Pat Harker speaking Thursday. Those are going to be key days because then we get very close to getting into the blackout period, and we won't have any guidance from anybody else at the Fed. And guidance is something it looks like the market needs. Take a look at this. Is the January 2024 Fed funds futures yield, and it is, you might say, rather volatile. They can't figure out where they're going with this, where the Fed is going, even though the Fed keeps telling them the same thing. Interesting debate over the weekend, by the way, on Twitter, for those of you who want to go back and look at it. Paul Krugman and Austin Goolsbee, along with Ivan Werner, a prominent economist, talking about whether wages actually predict inflation or not. Krugman suggesting that if you use something like the Cleveland Fed trim mean or something and look at the Atlanta Fed business expectations index, you can get an idea that inflation is starting to go down, where Goolsbee says it's too soon to say that because people don't ask for wage increases until they see prices going up. So if the intelligentsia is not united on this, you can imagine the Fed is not. So a lot of thinking about what's going to happen yet to come.
Mike McKee, thank you, sir. Tons of Fed speak this week. I keep saying this morning. It's a quiet start to an otherwise very busy week. Your broader equity market is basically unchanged on the S&P 500. Some churn beneath the surface with the sector price action. Here's Abby.
There certainly is, John. It's pretty interesting for such a flat surface. We have one sector up more than 1%, one down more than 1%. Real estate is the best sector. Interesting also because yields are higher. So typically this sector would not benefit given the fact that dividends are important and they go higher or they look more attractive when yields are lower. Communication services being dragged down by Google, down 1.4%. If we take a look at the banks, which we've been looking at all morning, it's really interesting because the XLF and overall bank ETF, well, it's now slightly higher, but what I wanted to highlight, take a look at State Street, the custody bank, down 14.5%. Their results simply missed right across the board. Schwab turning it back around despite their deposit issues, and then JP Morgan Chase adding to Friday's big gains, John.
Thank you, Abby. Thanks for that. The big banks reporting later this week. Bank of America, Goldman, Morgan Stanley, then a whole host of regionals we'll break down for you through the week. Up next on the program, your trading diary.
Day like Bloomberg.
25 minutes into the session, equities positive just about 0.1% on the S&P 500, down just about 0.1% on the Nasdaq 100. Pretty snoozy stuff so far. That's the price action. Let's get you the trading diary. Coming up, Speaker McCarthy addressing the New York Stock Exchange at the top of the hour. Richmond Fed President Tom Barkin speaking at noon Eastern. Big bank earnings continue Tuesday with Bank of America and Goldman. Morgan Stanley reports on Wednesday, plus we get the Fed's base book too. Another round of jobless claims coming on Thursday and more Fed speak from Waller, Mester, Bauman, Boster, Harker. Before the quiet period, we round out the week with US PMIs on Friday. From New York City, that does it for me. Great to be back here in the heart of global markets in New York. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, April 17th. Here are the top market stories that we're following for you at this hour. Some State Street pain. The bank misses on earnings as clients pulled back on investment in products. That stock's still down about 13%. And Charles Schwab hitting the pause button. The company halting share buybacks due to regulatory uncertainty and sees more deposit erosion, but that stock now up by 0.5%. And the banking stress peak. There are pockets of pain for banks. CEO commentary is still cloudy while the data holds in. New York manufacturing activity soars. We're going to try to make sense of the good news versus the bad news. From New York, I'm Alex Steele with Danny Berger in London. Guy Johnson is off today. And Danny, we're going to get into the specific numbers for some of these guys like State Street and Charles Schwab. But I'm really struck at how strong that New York manufacturing activity was, and even more importantly, how strong the new orders was, the highest that we've seen in about a year.
Right, and this gets to the point of whether or not the banking stress has had an impact on the real economy. Earnings are still going well. The data for the most point is strong, but is this the eye of the storm, or are we past all of it?
Yeah, and it didn't take much for Charles Schwab to turn into positive territory, which also begs the question, like, how much is actually baked in? They see deposit growth reaccelerating in the back half of 2023. So if the bad news is already kind of priced with some of these guys, State Street notwithstanding, I mean, have we already priced that in then?
I got to say, that's so remarkable. It's been such a jittery market. And the fact that Schwab is up at the moment, okay, it's not up a lot, but deposits were painful for them. It is a jittery market, but it's one that's happy to buy Schwab this morning. And Alex, that does bring us all to the question of the day, trying to wrap our heads around all of this. Are we past the banking stress peak? Again, for the banks themselves and the wider economy, it feels like a puzzle right now. Let's try to put the pieces together. Joining us are Bloomberg Sonali Basak and Edward Harrison. Sonali, I just want to start with you on the Schwab numbers. What do you make of the fact that Schwab is heading higher now?
Listen, it's still early in the day. It will be interesting to see where it ends because there was good news and bad news. Deposits, the fall in deposits, it was steep, but it met estimates really by what Wall Street was expecting. But listen, the reason that the deposit pressure is such a big deal is the cost of funding also drops with that. On the other hand, you do have Schwab pulling in more than expected when you look at total client assets, net interest income becoming above expectations, net new assets in certain trading products, investment products, which is something different than you saw over at State Street. Really, that number in investment products really falling below expectations. Wall Street is taking a second here to see where the profitability question is. It seems that we are out of the immediate storm, but how are these firms going to make money, especially if you think the environment can get a little bit worse from here?
Right, that's a profitability issue for these guys versus a broader economy issue. Edward, so do you think that we're back past the banking, this is hard, past the banking stress peak?
Yes, I do. I agree with a lot of what Sonali just had to say. I think that the acute crisis is over except for the likes of, say, First Republic. Other banks, the question is the profitability going forward. So, for instance, with Charles Schwab, what you saw is actually as their assets matured, they were able to invest them at a higher rate. So that's very positive for them. The negative, obviously, is that long-term interest rates are relatively low. You know, we've seen the long end of the curve rally. And if those numbers, like the Empire State numbers, continue to come in relatively good, then what we're going to see is a sell-off in long bonds, which will add pressure. So there's not an acute crisis, but I think there's still lingering doubts, and then you have loan loss reserves on top of that. So we're not out of the woods yet.
Hey, Ed, Alex also mentioned the fact at the start of the show that we also had State Street down really significantly, seeing clients move away from their products. And then at the same time, you're looking at BlackRock, analysts saying in 5 years from now, they'll have $15 trillion. Are we now witnessing a large bifurcation of these financial companies, financial services, and the banks for that matter?
Yeah, it's a good question because I think that, when you look at merger accounting as an example, what you see is that you have to mark to market from a merger perspective. So the regionals that have all of these these loans and all of these government bonds at significant mark-to-market losses, they're not going to be able to use M&A as a vehicle to expand. So you're potentially seeing a bifurcation of the market, especially to the degree that deposits are flowing from the smaller banks to the larger banks. And I think that in addition to that, it's a sign of a certain weakness in the market. If you look at the cap-weighted versus the equal-weighted S&P 500, we're at near highs for the year on the normal cap-weighted, but on the equal-weighted, we're not. So there's a narrowing in terms of the leadership in the market. And I think that State Street sell-off is an example of how the market is punishing firms that do not deliver on earnings.
So, and that really begs the question, Shonali, like, how does that then resolve? We'll talk about First Republic later on in the show as well, but like, who's going to go buy that, or who's going to go buy pieces of that? Like, how is that situation going to resolve? Because that does wind up seeing then how these banks are going to loan, what they're going to do with other companies, what kind of assets they have to sell, etc.
Yeah, and I think when you think about the stresses ahead in the market, you have to think about the different types of areas these banks lend to. If you're JP Morgan or Citigroup, you have a massive credit card portfolio, and those charge-offs are not ticking up to crazy levels. They're ticking higher, but they're normalizing, as the executives like to say, which means that they're willing to lend, they're willing to take some losses in order to lend for that net interest income. Same with large corporate clients. Should they be healthy enough to make it through this crisis, the big banks will lend to them. But if you look at what the NFIB survey is telling you about small businesses, they're finding it harder to get loans. The commercial real estate exposure, Wells Fargo, which has a very small percentage of its book tied to commercial real estate, is warning of more stress, and we have a whole week of bank earnings ahead with firms where a lot more of their loan book is tied to commercial real estate. So now it's a matter of parsing through the market and seeing where the stresses are and will be, because we haven't seen the worst of it yet. So, Danny's question was a smart one. It's a question of profile. Big banks have flocked to more profitable activities that they could do at scale. And you look at the likes of even, for example, BlackRock, they're benefiting from this banking crisis as people move to money market funds. They have one of the largest ones. And so then what does the shakeout look like? To Ed's point, M&A is not the simplest answer in all regards. So the full scale of the shakeout of this banking tremor, crisis, whatever you want to call it, has not been seen or felt. The question is, how does it end?
Shonali, we're showing a calendar right now of the busy week ahead for bank earnings, both large and small banks. What in there are you specifically looking out for to get a better gauge on where the banking system is going?
Yeah, I think it's really hard for the market to look in the long term here, right? Because if you look at a Zions, for example, or an East West Bancorp, according to Bloomberg Intelligence, as a percentage of these loan books, those are some of the biggest exposures. But you're not going to necessarily see a fall off in this week. But the outlook could last be under pressure for the next 6 months, 12 months, 18 months. And so gauging how much pain is really in that sector and how that flows into the market is one thing. But then you have the more immediate results. Goldman Sachs, Morgan Stanley, the other banks, the big banks that have reported, have shown you that their trading figures have been stronger than expected. Not to mention, JP Morgan had that surprise deposit increase. At Morgan Stanley, they would have presumably been a big beneficiary of a lot of the banking movements we've seen over the last couple of months. The question is, how much of a beneficiary? Do they have the same net interest income expectation as well, because they have perhaps gained larger banking clients, ones that need funding, and high net worth individuals that now might be looking to Goldman or Morgan Stanley to get their loans? A lot is changing this week. The question, is it going to change the near-term outlook, or is this a long-term play that the market needs to start being more aware of?
Hence our question. We don't know the answer yet. We got to get to this week maybe to get more clarity, guys. Thanks a lot. Really appreciate it. Shonali Bassick and Edward Harrison joining us from Bloomberg. So coming up, we're going to do more on our question of the day. Are we past the banking stress peak? And if not, kind of where does that show up? Stephanie Lang, Hormrick Berg CIO, is joining us next. This is Bloomberg.
there's not a lot of stress for the broader market that's actually priced into the equity market. So, we've had a relief rally off the lows in terms of March. I'm not sure that regional banks themselves finding some stability is enough to really help the market from it.
That was Greg Buttle, BNP Paribas U.S. Head of Equity and Derivative Strategy, speaking earlier on Bloomberg TV. And that brings us to the question of the day. Are we past the banking stress peak? Joining us now is Stephanie Lang, Hormrichberg CIO. Stephanie, what do you think? We passed it?
I think the big crisis is over for now because you had all these Fed programs come in, and these banks aren't going to be forced to sell these securities at a loss. But we have to acknowledge that, prior to Silicon Valley Bank failing, no one was talking about Silicon Valley Bank. So I don't think you can raise interest rates as quickly as you have and as far as interest rates have been raised without feeling some stress in the market. So whether, it's the immediate issue with the loans and the mortgages on the books or something else, I think we're going to be feeling knock-on effects from the rates going up from here.
Has the issues we've seen in the market over the past month then, is it enough to replace Fed hikes? That's what Janet Yellen mentioned over the weekend speaking to CNN, that maybe some of the credit tightening to come from it can do so. Do you see any evidence that that might hold true this year?
Yeah, there's already some evidence that financial conditions are tightening. And so with that can take place, future rate hikes. But I think, at this point, everything's baked in. You're going to get 25 basis points in May, and then there's going to be a pause. Now, the disconnect right now is between the market thinking there's going to be cuts later this year and the Fed saying that they're going to hold tight and fight inflation until it gets to its target. So I think in the near term, kind of the rate hikes are priced in. So that financial conditioning is just a knock-on effect of what's already occurred with the banks, with interest rates. And so I think that's going to filter through further to the economy.
Okay, so would you agree then that we're going to get a tougher time going forward and the Fed's going to have to cut and that you should be selling, in theory, equities? Like, I appreciate that if the Fed cuts, that should be good for equities. I put that in quotes, but that if they're cutting, it means that stuff is really bad. And therefore, how can you possibly own equities? Because profitability is going to be a problem.
Yeah, I think, be careful what you wish for, because with everyone hoping that there's going to be a pivot, essentially, if you look back at rate cuts in the past, a pause has actually been pretty good for markets. You've seen 5% on average over 100 days. But when the Fed cuts, there's typically something they're reacting to in the broader market that they need to come in and provide liquidity, provide some stability to the market, to the economy. And, in past rate cuts, you've seen declines of about 23% over about a 6-month period. So we're a little bit cautious here that if there is a rate cut, there is, further deterioration in the economy. And we were already quite cautious, even before this banking debacle, if you will. There was a lot of signs out there that were pointing to a recession, would be coming down either, later this year or early next year.
Stephanie, you then like private investments as a way to get some exposure in this difficult environment. Why, though? Is there not some degree where private investments are also going to be closely linked with this cycle?
There is a link, but what I would say is if you take private debt, for example, typically you're lending directly to the company, and so you can step in and try to find a solution a lot easier, where if you're just buying a bond, it's tougher to really enact change in that manner. So you can get a lot higher yields than you're getting in the public markets. They do not mark their value quite as often. So for our clients, whether there is volatility on a day-to-day basis in the public markets, because you don't see those marks but quarterly, it helps investors to kind of sit for the long term and clip those coupons that are higher than the public market. So it's been, a real win for our clients, and it's something that we're leaning into at this part of the cycle.
Stephanie, how do you lean into it? What's the best setup for that?
So there are some funds out there called interval funds that do provide private loans to private companies. That's an easy way for the everyday investor to access that. There are also private partnerships that take some qualifications. You have to be a larger investor. It's called qualified purchaser, that you can do it in that manner too. But there's been a proliferation of products to bring private debt to more and more investors. So I would say, there are more opportunities for kind of the everyday investor at this point.
There was a recent Bank of America survey of their FX and rates clients. So of course, the idea being that they're not going to be directly investing in these types of markets, Stephanie, but they said when it comes to pockets of potential stress, they think commercial real estate and private asset valuations top the so-called investor risk list. What would be your message to investors who think that this is the next big risk, that this is where the next crisis erupts from?
Well, I'd say on the commercial real estate side, I would agree with that. And, where there is stress, there's opportunity. So the banks are going to have a big problem. They can extend and pretend like they did the last time. But ultimately, there's going to be some refinancing situations that don't make sense, and there's going to be big markdown in assets. So a lot of these private lenders can come in and they can lend at much higher rates than they have in the past at much safer positions. So I would say, for existing investors, you could see, a lot of stress, whether it's in commercial real estate, or you've already seen in some of the private companies like venture, sky-high valuations that have come down and are still being priced in. So, you have to be cautious and look at the particular investment. And I would also say between private and public investments, there's a much bigger dispersion of returns. So in the public markets, it's very hard to beat an index. But in the private markets, if you're with the right manager, you can tend to really outperform. So you got to be picky.
Okay, Stephanie, great to get your thoughts this morning. Picky in this current market environment. Stephanie Lang there, Homerichberg CIO. Still ahead, SpaceX postpones the launch of its Starship rocket because of a pressure issue. We'll have the details next. This is Bloomberg.
Great questions.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Angel Feliciano. ECB President Christine Lagarde says she doesn't foresee the U.S. defaulting on its debt. In an interview with CBS, Lagarde said she is confident the U.S. will not allow that to happen, saying it would have a negative impact globally. The Biden administration is locked at an impasse with the Republicans over government borrowing and related spending cuts. Merck is to buy biotech company Prometheus Biosciences for about $10.8 billion. The agreed price is a 75% premium to the target's closing price on Friday. Merck is looking to bolster its research pipeline and strengthen its portfolio of autoimmune drugs as it faces losing a key patent later this decade. And UK Prime Minister Rishi Sunak is expected to receive a boost this week. That's as inflation slips back into single digits. It's raising hopes that the quickest series of interest rate increases in 3 decades is nearing an end. Figures this week are expected to show inflation dipping below 10% for the first time since August and a cooling in the labor market. And that's your Bloomberg Business Flash. Alex?
All right, Angel, thanks so much. Really appreciate it. It is 22 minutes past 7 on the West Coast. Beautiful sun of, well, maybe a little cloudy. We're going to get to the startup. We cover the top tech stories from the Bay Area and beyond as Silicon Valley starts this morning. Joining us now is Bloomberg Technology co-host Ed Ludlow. Ed, got to do SpaceX. Plan to launch on its massive Starship rocket. It was scrubbed. We're still kind of on watch for when it's going to be rescheduled. What happened?
Yeah, there was a frozen pressurant valve, and going into this launch attempt, Elon Musk had tried to set expectations very low. He hosted a Twitter Spaces for subscribers only last night, where he basically said the chance of it being scrubbed was greater than launch. And what they're trying to do is technically very difficult. It's at a scale that the space industry has never seen. Right? This is a combined launch system that has twice the thrust, of Saturn V, which last flew in the 70s, right? 16.7 million pounds of thrust. And he basically said that, look, if there was any risk at all that there would be catastrophic damage, particularly to the launch pad, stage 0, we would just halt and try again. And I think that actually the main takeaway is that SpaceX, by doing this kind of wet dress rehearsal, learned a lot about the Starship launch system, which, remember, they've never launched as a whole combined system with the stage 1 booster, super heavy booster, and the spacecraft, which we're showing on our screens right now.
Yeah, it is an absolute behemoth of a rocket. Ed, what's at stake here if they can't get a launch together in a quick timeline, if this keeps getting delayed?
The kind of profound, forward-looking stake is that, this is the ship that's designed to take mankind beyond Earth's orbit, right? In the first instance, to the moon, and beyond that to Mars. But, really, all they wanted to try and do in this attempt was get it off the ground. Musk was talking about if they even just cleared the launch tower, that would be a great success. There was going to be no attempt to land the booster or the spacecraft. The idea was that if it successfully reached orbit, the booster would fall into the Gulf of Mexico and sink, and the spacecraft would splash down off the coast of Hawaii about 140 miles off. That's what we're talking about in the first instance here, just proving that this next generation space system actually can literally get off the ground.
Ed, will those eventually be reusable?
Yes, fully reusable, and that is the long-term goal. The economics of Starship and the long-term hopes of being able to launch at a regular cadence fully require it to be reusable. There have been, if we bring the pictures back up of spacecraft, there have been 9 attempts to do high-altitude tests of spacecraft. Only 1 of them have ever worked. That's where we've got to in the life cycle of this space launch system. In the first instance, we're just taking one significant step to proving that a combined system that's 120 meters, 394 feet tall, is actually capable of getting off the ground. But in the future, landing it back on Earth is certainly the goal.
And I'm guessing the goal, quickly, Ed, here is still get humans to Mars.
It is, but in the first instance, the next stage of tech demo is that they can refuel in space. So it's one thing getting to orbit, but in order to have the propellant load to get us to Mars, SpaceX's next challenge is to work out how to fuel outside of Earth's atmosphere. In other words, couple 2 spacecraft together in orbit, refuel, and then go on to Mars. You can see we're quite distant from the long-term goal.
Yeah, certainly no small feats. Ed, thank you so much. Bloomberg's Ed Ludlow. I don't think I'll ever get tired of looking at the pictures of the most powerful rocket ship we've ever seen. Of course, you can catch Ed as co-host of Bloomberg Technology. That comes up in around 90 minutes at noon Eastern. That's 5 p.m. here in London. Coming up, Love Interrupted. If you're like me, you were heartbroken that we didn't get the live viewing of the Love is Blind reunion. We'll have more on that next. This is Bloomberg.
We're about an hour into U.S. trading. Volume not necessarily remarkable, but it looks like the S&P is trying to stay in positive territory. Abigail Doolittle is back and tracking the moves. Abby, good to see you.
You too, Alex. And you know, it's interesting because we have this real mixed picture here for these various indexes. The S&P 500, to your point, trying to stay positive, very small gain there. China tech stocks really outperforming. The chip stocks here in the U.S. underperforming, and then the banks also underperforming. All of this as yields are higher on the day. Now let's take a look at yields over the last month because it has been a wild ride. This is the 2-year yield, and it doesn't quite show the plunge out of the banking crisis, but you can see this sideways range since, and right now we do have yields higher, back above 4% for this 2-year yield, perhaps putting some pressure on stocks. On the other hand, we've already been here, so the S&P 500 doing okay. In fact, if we take a look at the range ongoing for the S&P 500, I think the best we can say here is it's very clear that the trend for the S&P 500 is sideways. That said, we do have a small break out of the range. Will it be a bigger break? We don't know. The RSI is not overbought yet, and it could continue to go higher. Ari Wald over at Oppenheimer always teaching me that an RSI rising is a positive thing until it turns back down. That hasn't happened yet. As for some of the movers beneath the surface, Microsoft up 0.5%, Alphabet down 3.4% on reports that Samsung might start using Microsoft Bing as a default search engine as opposed to Google in some of its devices. Bank of America up ahead of earnings tomorrow, and then State Street, Danny, down 12.4% off of its lows, and this as the report, the earnings really not great for the custodian bank, the worst day since March of 2020.
Yeah, certainly not. And the week continues heavy with those bank and asset management earnings. Abigail, thank you very much. Abigail Doolittle. Now we're going to do a hard pivot to the world of Netflix and Love, perhaps. Alex, did you try to watch the Love is Blind reunion last night?
No, I didn't. However, I am eagerly waiting to download it on my phone whenever it happens.
You and me both. Look, I'll be completely honest. Obviously, I've been watching the markets, but I've also been looking at my Netflix app to see if this thing will play. I'm not embarrassed to say it, but look, this is the thing. They were supposed to have a live reunion, and now Netflix is apologizing after it experienced technical difficulties during the highly anticipated reunion of the best dating show, I think, Love is Blind. Here to talk more about live programming glitches, Geeta Ranganathan, the media analyst for Bloomberg Intelligence. And Geeta, look, we joke, right? But this is something Netflix wants to do more of. They want to get into live programming. But this very highly anticipated thing went wrong. What does that mean for them?
Yeah, they've been trying to get more and more into live programming ever since they hit that subscriber wall last year. So, they're really kind of trying to expand their programming repertoire, if you will. So more of this unscripted stuff. Reality series really kind of works well with live programming, whether you're doing a comedy stand-up. And they had a successful one with Chris Rock just a few weeks ago, whether you're trying to do, these kind of reunions, whether it's, broadcasting an award ceremony. Again, this live streaming kind of really lends itself well to that. Well, yesterday's event, I think, or rather the disaster, the fiasco that happened, I think obviously it does create some bad press for them. But at the end of the day, any press is good press, and I think, this will blow over for Netflix.
I mean, we're definitely showing Love is Blind reels right now, so there's that. Geeta, do we know what actually went wrong? Because it feels like what was different with this versus, say, the Chris Rock show is there was going to be interactive viewers' questions, right? Like, what went into making this not work?
Yeah, I'm not really sure. I don't think we have any certain answer from Netflix just yet. I know Vanessa Lachey was posting stuff to her social media account kind of suggesting that, you all broke the internet. So maybe there was a technical glitch. I'm not really sure just yet.
Yeah, she also said don't go anywhere, don't leave the couch, don't go to the bathroom, which I'm sorry, if you listen to her, you'd have a real problem right now because it still hasn't come out. Geeta, look, we're also going to get Netflix earnings after the bell tomorrow. What are you looking out for?
Yeah, so this is going to be a really interesting report from them. So this is the first time that we're not really going to see any concrete subscriber guidance. They've moved away from that. It's really now more for them about the overall revenue numbers. The overall growth story is really focusing now more on the financials. I think the two key things that we're really looking for from Netflix is their two newest initiatives. So one is the launch of their new advertising tier that happened sometime late last year. So we are still waiting to get some concrete numbers from them in terms of how many members they actually have on those ad-supported plans. The second one is a slightly newer initiative, which is really this crackdown on password sharing. And they have so far introduced page sharing, what they call page sharing. So you have to add a new member in 4 markets. So they've done that so far in 4 markets. What we've heard so far, one of the markets was Canada. What we heard so far from the Canadian market was there was quite a little bit of a backlash when they first introduced that. But things seem to have settled down. So again, any color that they can provide on, initial takes, how they're planning to do this in the U.S., because the U.S. is really a big market for them where kind of mooching off of other people's passwords is a huge, huge problem. Overall, globally, it's supposed to be 100 million households, which is, again, it can potentially present a huge opportunity if done right. So again, that's something that we're really kind of looking to see what exactly management tells us.
In the meantime, the stock is down about 1.5%. Yes, it's had a nice solid run so far this year, but nonetheless, down 1.5%. Geeta, thank you so much. Geeta Ranganathan of Bloomberg Intelligence. 3 p.m. apparently is when the reunion episode is going to be aired. We'll see. All right, coming up, we're going to get some more insight into our question of the day. Are we past the banking stress peak? Piper Sandler Managing Director and Senior Research Analyst is going to be joining us, Frank Schiraldi, next. This is Bloomberg.
Keeping you up to date with the news from around the world, here's the first word. I'm Angel Feliciano. SpaceX called off the first launch attempt of its nearly 400-foot rocket deep space rocket Starship today. The company plans to use Starship to send astronauts and cargo to the moon and ultimately Mars. SpaceX says it postponed the launch because of a problem with the first stage booster. There won't be another try until at least Wednesday. Nuclear powers within the group of 7 nations have pledged to end Russia's dominance over global atomic fuel markets. That could cut off a critical source of geopolitical currency for Russian President Vladimir Putin. Canada, France, Japan, the UK, and the US committed on Sunday to jointly remove Russia from global nuclear supply chains. And gunfire and explosions rocked the Sudanese capital for a third day. That's as diplomats intensified efforts to stop clashes between the army Army and a paramilitary group from escalating into a full-blown civil war. A long simmering dispute erupted this past weekend into a battle for control of the nation. Nearly 100 people are reported to have been killed. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Alex?
Angel, thanks very much. Really appreciate it. This is a big week for banks across the board, whether you're big, whether you're small. We got Charles Schwab. I appreciate it's not a bank, but we also got State Street today and M&T. Today, the big take for Bloomberg is a fascinating piece, and it talks about First Republic and what kind of went wrong there. Apparently, there were tons of loans to wealthy clientele that were interest-only mortgage payments. We saw that back in 2007, 2008, but with riskier borrowers. These are high net worth individuals. It was a fascinating read. I very much recommend it. And here to discuss, Bloomberg finance reporter Jenny Serrain. Jenny, walk us through what you guys found as you were doing the research here.
Yeah, so I think to kind of take a step back a little bit, a lot of folks going into this earnings season, like you said, have really been looking at the unrealized losses sitting on banks' balance sheets. And in most cases, that was the bonds that they were invested in back in 2020, 2021. As rates have risen, those bonds have lost value. In First Republic's case, that's actually a really small portion of the whole on their balance sheet. A much bigger portion comes from their mortgage book, actually. And so what we learned as we dug in was that the vast majority of their mortgage book is these interest-only loans. And so the bank, as rates have risen so quickly, they've had to write down the value of these loans. And especially, we've reported previously that they're looking at, a capital infusion or potentially selling themselves. And that's just made it really hard because a lot of buyers, as they look at this, would instantly have to recognize that loss. And so it's just made it really hard to find a partner to partner up with.
Jen, why can't we say that these are wealthy customers they're going to be paying back the principal, they're fine, they're financially in good shape? Why is that not the case? Why does this matter now? Why are we worried?
Yeah, no, I actually think that's a great point. There is no one saying that we're suddenly worried about the credit risk of these loans or some huge rise in charge-offs. It's exactly the opposite. It's really just interest rate risk that was sitting kind of hidden for years, or for quarters at least, on their balance sheet. And so that's really the issue here. It's not a credit issue like we saw back in 08 and 07. This really is just rates rose. It forced them to write down the value of these loans on their balance sheet, and now, as they're looking for partners to merge or partner with, or even capital infusion, it's making the accounting of that difficult. And so this really is not worried about, millionaires and billionaires going bad on their loans. It's really just an accounting thing.
So is there any way that there could be some kind of rescue funding that involves a partner not having to write down these loans at immediate first blush?
Yeah, so our sources are saying that that's been something that's given a lot of folks pause, and so that was kind of the impetus for our story today. But it is our understanding that you could still see a deal here if they were able to engineer a deal where there wasn't a change in control, for instance. So there's a couple of different workarounds. The deal is not impossible, but we've just heard again and again that this is one of the big issues and one of the big hangups for folks looking at First Republic.
Okay, Jennifer, thank you very much. That's Jennifer Serrain. Of course, go check that out at NI Big Take Go. Now, we had M&T Bank, the regional bank, of course. It reported results, and they surpassed analyst estimates. It also comes on the heels of solid earnings from the big banks like JP Morgan and Wells Fargo. All of that brings us to our question of the day. These earnings are strong. So are we past the banking stress peak? Joining us now is Frank Schiraldi, Piper Sandler Managing Director and Senior Research Analyst. He has an overweight rating and a price target of $155 on M&T Bank. Frank, thanks for joining us today. So what say you? Are we past the peak of banking stress?
Look, I think we are. I think if you look at the names, these guys are trading. A lot of my names are trading 6-7 times. Next 12 months earnings. Historically, the banks are trading 12, 13 times that number. So I do think most of this, if not all of it's baked in at this point. Now, I'd say that assumes, we're going into a mild recession. If credit losses do end up looking like they did during the Great Recession, then yes, there could be another 10, 20% down. But I don't think we get there. I'd say, the caveat is it's sort of hard to convince investors of that before you start to see credit deteriorate, hard to get them interested in the space ahead of that.
Hey, Frank, it's Alex in New York. Can you walk me through M&T for a second and the deposit mix and any shifts that we saw and what it actually means for profitability for them?
Yeah, I mean, look, I thought it was a pretty good result. We saw deposit outflows of just over 2.5% linked quarter. I think for any bank, just given what we saw in terms of the turmoil in the industry in late March, any bank that can report low single-digit deposit outflows in this quarter, that's a big victory. So, I think their profitability is going to hold up better than most. We did see certainly, some transition from lower cost deposits into higher cost deposits. So that is going to pressure margins. That's what you're going to see industry-wide. But I think you're going to see it to a lesser extent here at M&T, just given their stronger deposit franchise.
Is there not some elements of politics that comes into this, Frank? If we're talking at the moment of a banking crisis, worried about keeping deposits, and someone like M&T has really strong net interest income, is politics going to come into play, especially if we start to see more Senate congressional panels on this sort of thing?
Yes, that's a great point. I do think there's going to continue to be regulatory pressure. And, I would just say that at the end of the day, I think particularly this asset size group in M&T at $200 billion in assets, they have slightly less regulatory pressure right now than the really big guys. But, best practices really is to follow everything the bigger guys are doing anyway. So, maybe I'm an optimist at the end of the day, but I don't think, a little bit of a heavier hand on the regulatory side is really going to be that impactful to earnings. I think the bigger pressure here is margins.
So the call's beginning in like 15 minutes time. What's going to be your biggest question then? I'm just taking a look at the stock, bringing it up. The stock up 1.3%, so okay, pretty solid. What's going to be your biggest question or concern?
Yeah, I think you want to find out more detail about the mix of the deposits. As I said, you saw just under 3% outflows, but you did see greater outflows in terms of the non-interest bearing category. So you want to know are you basically paying up for current customers? Is there some additional brokered in there? So you want to get a sense of really how the last couple of weeks of the quarter played out in terms of their deposit base. And certainly, you want to get some detail on outlook in terms of, where they expect the margin to go to now that they, have seen deposit costs and what they've done through the end of this first quarter.
So, Frank, loan loss provisions were raised. They were $900 million in the prior quarter. They're now at $120 million. Does that seem like a conservative figure to you?
I think that's pretty reasonable. It's pretty much exactly in line what I was expecting. It's pretty much in line with consensus. I think it more so reflects the expectation of broader economic deterioration than anything else. So I don't think it's an outlier here.
Frank, today, this week, next week, busy week for the regionals. You cover a bunch of them. Where's your biggest concern right now? Which bank?
Well, I wouldn't want to speculate in terms of, a bank to the downside here. I don't have the space I cover tends to be the more super community and community bank space. I would just say more broadly, I think the greatest concern in the space is number one, deposit pressure and outflows. And secondarily, credit. You could start to see some credit one-offs this quarter, and I do worry that if you do see, a credit loss, a sizable credit loss for a bank, I do worry what that means for depositors kind of looking in from the outside.
Could that come in the form of commercial real estate, Frank?
Yes, it's certainly, I think it's commercial real estate is an area of concern. I think unsecured consumer, we've certainly seen some hiccups there. So, that's kind of where I would expect to start to see some modest pain here is on the commercial real estate side as some of these borrowings start to get refied.
All right, Frank, we'll let you go. We know you have a analyst call to go pay attention to. That's Frank Schiraldi of Piper Sandler. Now, coming up, a big day in pharma M&A as Merck unveils its plans to buy biotech company Prometheus Biosciences for nearly $11 billion. We'll have all the details for you next. This is Bloomberg.
All right, well, Merck stock is down slightly after striking a deal to acquire Prometheus Biosciences. That stock just soaring today. The $10.8 billion deal, one of the largest pharma acquisitions in recent history. Sam Fazeli of Bloomberg Intelligence joins us now. Now, Sam always gives me heat because I only have him on when like COVID's spiking or the flu's really bad, but this proves me right, that I'm going to have you on for good news. Do you like this deal? I mean, is it a lot of money to pay for something that they kind of had to pay for?
Well, look, Alex, thanks for having me on for some good news. We do have a company that's $311 billion market cap or enterprise value, paying 10 point something for a pretty exciting drug, I have to say. Prometheus had some really nice data that showed their drug for inflammatory bowel disease. To some people, that's Crohn's disease or ulcerative colitis, looking like one of the best data sets that have ever existed for this disease. Small trial, but obviously Merck's looked under the hood and liked the data. So, and it's an area that they know, and it's not something new to them. So they should have been able to do some really good due diligence here. And they need drugs to try and fill a hole that will be created by the patent expiry of this magical cancer drug they've got, Keytruda, that comes in 2028.
Speaking of those patent expiries, Sam, analysts over at SocGen said, hey, this deal is nice, but it's just too late considering that cliff they're going to face. Would you agree with that?
Yeah, so we called it a deal that will help chip away at the exposure. Too late. I mean, 2026 is our estimate of when the drug will be potentially on the market. And yeah, I mean, it's going to come to at a point where there's already the current behemoth in the disease, Stelara from Johnson & Johnson, is going generic next year, and therefore that commercial dynamic could be tough. It won't make a huge dent in a $33 billion drug that's going off patent in 2028. But you need to take things as they come, and this is a good drug. It's in a good space, and it's a nice business to have.
Do you think that Merck needs to diversify even more and buy even more stuff, or are they good for now?
No, they need more. I mean, they've done some good M&A deals recently. Acceleron being one of them was a good deal, and we've now got this other deal. There'll probably be more others coming along.
Hey, Sam, before I let you go, the NASDAQ 100 is up by 0.4%, and the biggest drag on that is Moderna. It seemed like their trial for their cancer drug wasn't terrible. Like, what's your read-through on this?
Yeah, Alex, it wasn't terrible. They have nice curves to look at, and the conference was, showed the more detailed data, but there's lots of questions still remaining, and there's some comments around the conference that perhaps the thing isn't working as well in other cancers that they've been testing in these basket-type trials that they do. So how big a product is this going to be beyond melanoma? And even in melanoma, you've got the standard of care that's changing that you need to be compared to. So it's going to be 2026 or so when it comes to market. They've pushed back the flu vaccine, and we have a cliff coming in COVID. How bad is that cliff? Nobody knows. So now this data is out of the way, I'm not surprised people are revisiting the downside here.
Okay, Sam, thank you very much. That is Sam Fazeli of Bloomberg Intelligence. Now, Alex, we got about 35 minutes until the market close. I don't have the data up for us at this moment. I will. But one of the interesting things, Alex, and we're going to talk more about this shortly, that blue chips in European equities were really, really close to hitting a new record. And there we go. Like magic, I do have it for you. But what do we have now? We have unchanged on the Europe Stock 600. Volume has been really low. No conviction in this market. Dollar, that strength continues, meaning that the best performing G10 currency year to date, the Swissy, taking a back seat, as does the euro. Now, coming up, we're going to talk more about FX and overall these markets with Deutsche Bank. This is Bloomberg. It's Monday, the 17th of April. Feels like summer trading in the middle of spring. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Welcome to Bloomberg Markets. I'm Danny Berger in for Guy Johnson. Alex Steele is in New York. Now, I say these markets feel like summer markets because that's how we're trading. Volume is really light right now on European equities. It's so light that, again, it looks like the type of volumes we'd see during the summer holidays or even the winter holidays, New Year's, those sorts of things. And we don't have much of a direction either. We are unchanged on the Europe Stock 600, but we're coming off the back of 4 consecutive weeks of gains. The big movers this morning are in the FX space, and it's one of a stronger dollar. We're going to talk more about this in a bit as well, but the hedge funds on CFTC data have now turned. They're turned that they're net short every major pair of FX currencies versus the dollar. So you're seeing a weaker euro this morning. The Swissy also, which was a haven in the times of the banking turmoil when you didn't want to be long the dollar, but you still wanted a safe haven. Things like the yen and the Swiss franc did well. Again, that's unwinding this morning. Currently, Alex, the dollar versus the Swiss franc is higher by 0.5%.
Yep, hedge funds feeling a little better about the dollar as well. We'll talk about that later on in the show. All right, let's look at the S&P here. Pretty much going nowhere fast. I should point out the Nasdaq 100 is off by just 0.2%, but a big part of that is Moderna. They had their canceled drug trial out yesterday. It was okay, but you're still seeing some selling pressure on the stock. Talking about selling pressure on the stock, here are some of the worst performers here. You got State Street down over 12%. Their net interest margin disappointed. They put aside a lot of money for some credit provisions, and it just shows that for some equities like Charles Schwab, the news might already have been in the stock headed into the numbers. In other areas, it's not. Google, or Alphabet, so sorry, this is really interesting because you're looking at the weakest, potentially the biggest single-day decline in about 2 months. Basically, Samsung Galaxy phones could replace Google with Microsoft Bing as the primary default search engine. That would be something, I gotta say. The 2-year yield is up by 8 basis points. We saw it gain even more steam to the upside and to really have the sell-off in the bond market pick up steam as you got the Empire Manufacturing Index coming in super strong. New orders coming in super strong. And Danny, this is a little confusing in that some of the data, some of the survey data looks really good. Then you have CEO commentary looks really cautious, and those two things are hard to sometimes square up.
Yeah, and it doesn't help the Fed trying to figure out what to do. What is the Fed going to listen to? Soft or hard data? Of course, they enter their blackout period next week, so we're going to have to see what clues we can get from them until then. Alex, I was talking just a moment ago about European stocks being in this kind of summer doldrums. Well, we were really close to hitting an exciting milestone with the European blue chip index. The Euro Stoxx 50 at one point during trading today was back on this red line that I have on this chart. This red line is normalized in 2007, and we almost hit a 2007 high for the Euro Stoxx 50 index. Just to emphasize what a big deal this would have been, every other major index, the S&P, which is in white here, the MSCI World, which is in yellow, they've been able to hit new highs since 2007. But European blue chip stocks have not been able to. What's thrust them higher recently, Alex, you and I have been talking about this for a few days now. It's the luxury trade, things like that. But again, there seems to be some hesitation. Volumes are low, and we're really struggling, at least for today, to get back to that all-time, or not that all-time high, the 2007 high, Alex.
Yeah, well, for sure. And it's hard to, are we doing top-line growth and tech for the U.S.? Are we doing luxury and healthcare for Europe? It is confusing. So Cameron Dawson, New Edge Wealth Chief Investment Officer, was on Bloomberg TV earlier discussing the market volatility and how it relates to U.S. equities.
The fact that we moved down so much was simply because of valuations being so high going into 22. So that's when you roll forward and say now it's less about the valuation line having more downside, it's more about the growth line. But now, of course, we've seen valuations move up again, so we think they've returned as a risk to this market simply because they're extended versus history.
And Cameron talking about U.S. stocks there, but you could really say the same for Europe. Valuations have come back up, but still a far gap from the U.S. And that brings us to our question of the day. Can Europe blue chips reach new highs? They were oh so close to today. Joining us now is Bloomberg's Heather Burke and Nora Al-Ali. Heather, let me bring that to you. Can Europe blue chip stocks reach a new high?
Yeah, I think that we've already seen it happen with French stocks, and I tend to be bullish European equities. I think we've seen some real outperformance with the luxury trade, with Hermes, LVMH posting really strong results. If you look at a comparative position, European 12-month forward EPS, this is for the Stock 600, has been outperforming the S&P 500. So I think we're in a good space in terms of earnings growth. I also think certain really key sectors like banks have held up better than U.S. peers. You had Deutsche Bank coming out today saying that the sector's weathered the storm. So while there are some jitters, like volumes are low, European stocks are actually back to outperforming U.S. so far this month. So I think that we're on that road. It's maybe we just need, as earnings season really kicks off this week, another burst.
Hey, Nor, do you think that European blue chips can hit new highs, and what's going to lead that?
Well, I mean, Alex, that's a really complicated question, right? Because you do have recession concerns in Europe really playing a big part here as markets expect the ECB to continue to raise rates into the summer. Now, obviously, comparatively, we're looking at the Fed here. Now the markets are expecting that we will get maybe at least one more hike and then a cut potentially by September. Obviously, that's just a slight repositioning from last week. And if we want to compare European and U.S. Blue chip stocks, particularly banks here, you'll see definitely that banks have been weighing on the European stocks. But as Danny was just pointing to earlier, luxury stocks really rallying here on that optimism from China. Obviously, we've seen data from China last week tell us that the recovery there has really been led by the consumer spending there. It's not factory output, not factory growth there. So definitely, as we see the Chinese travelers coming into Europe, we definitely see some of a correlation or relationship with stocks in Europe really doing better, definitely the luxury ones. But the question here really, just how far can they rally? Can they really do, go to a record high or, the record from 2007? Or is that really a potential or a chance for some profit taking?
Well, to that point, volumes have been so light. What does that tell you, Nor, about the conviction behind any Europe equity trade?
It's been a question of low volatility in stocks since as far as I can remember, and that's about 6 months, give or take, right? And the reason here is because we do have a point of taking where volatility in the bond market is quite high, right? You look at the MOVE index in the U.S., and I know that's not, a barometer in Europe here, but you do see it coming down from the highs it's seen this year, but it's still quite elevated at around 1.5 times, the 5-year average. And that's telling you something. There's a lot of confusion here or, uncertainty about the bond market, not just in the U.S., but also in Europe, because that's tied to what we expect the ECB, the BOE, and the Fed to do, and how that's going to play out into the year. How is that going to impact recession concerns, in the economy? And then really, that's where you'll see some stock picking take into place, or potentially the investors looking into large caps and preferring them rather than the mid and the small caps.
But what's interesting, Heather, is that what the large caps also have is exposure to China. And I was reading Eric Nielsen's note of Unicredit, his takeaway from the IMF meetings, and he really predicts that the U.S. and China relationship will deteriorate further. And if that happens, Europe's in a really bad spot.
I mean, that is definite possibility. Historically, Europe has been more exposed in terms of its equities to international markets. It's more export-driven, including China. It's a very more cyclical-driven markets. Look at the German stocks with industrials and whatnot. And theoretically, any improvement in the Chinese economy, which we've seen in some data, should be good for these cyclicals, your energy, your industrial, your chemicals. We've seen a couple good reports out from some cyclical companies such as Volvo and BASF. While they may or may not be China-linked, more strong reports like that suggest that maybe Europe is avoiding the worst of these recession concerns, and that could also bring some more upside.
Really great conversation, you guys, and a great way to set this up for us. Heather Burke and Nora Al-Ali, thank you so much for joining. So coming up, we're going to get more on our question of the day. Can European blue chips reach new highs, and what are the dynamics around that? We're going to speak with Zeynep Öztürk-Ünlü, a Deutsche Bank EMEA CIO. This is Bloomberg.
High inflation, lower economic activity, and a fall in international trade.
You are looking at live shots of ECB President Christine Lagarde. She is currently in New York speaking at the Council on Foreign Relations in New York. She is talking about more potential instability arising from waning supply elasticity, talking about the completion of a capital markets union being key for the euro, also talking a bit of geopolitics, talking about more multipolarity, of course, when there are two nation states with equal amounts of power. So very macro, high-level speech she's currently giving. And as she's been giving that, European equities struggling to post any gains. The euro sinks further. Now, let's get to our question of the day. As European blue chip stocks are unable to reach new highs today, will they eventually be able to do so? Of course, they've gotten a boost from China, from the luxury goods sector very recently. What is the next leg of gains? Joining us now is Zeynep Öztürk-Ünlü, Deutsche Bank EMEA CIO. Zeynep, thanks so much for joining. So can European blue chip stocks, can they reach a new high this year?
It's a very difficult question because if we look back where we were at the beginning of the year, we are talking about more than 15% return year to date. So European stocks, blue chip stocks have really performed very well already. And where will they go from here in an environment where we have a lot of macro backstops is quite tricky to say. So for us, we have been overweight Europe versus US since the beginning of the year, and it was a great trade. But going forward, I think it will be important to be a bit more cautious about Europe.
Why? Zeynep, is it valuation or is it fundamental? What's going on?
At this point in time, now that we are just starting with the earnings, I think it's important to see where we will end up. When we look into the pre-earning announcements, there is about like 80% negative earning numbers that are being expected. So will it be that case or not? I think it's important to see. The backdrop that we have also experienced with the stress in the banking sector has impacted the sentiment a bit. So having a bit of a recovery from there until now,
has been great, but when we now look into the future core macro, core inflation is still elevated, and ECB is not coming up with saying, okay, we're done, no more rate hikes. I think they will continue with their rate hikes. So it's not a negative view on Europe, but we have already performed really well in the European equity market. So there might be some more upside, but it won't be, in my opinion, too high from where we are now.
Do you think investors are being complacent on the likelihood that we get persistent inflation in the Eurozone?
I don't think it was a complacency, but it was more around day by day, week by week, month by month, kind of a data view. And when we have a good feedback that came from the energy prices and the gas storage, these were all very positive, and it helped sentiment to pick up in a very positive way. But still looking into the core, especially on the shelter and the cost of construction, we still see that it's quite sticky.
Zainab, Karen Ward over at JP Morgan had a great quote. She's like, look, the markets are desperately hoping that Goldilocks is on her way back, bringing with her low inflation, but that's diluted. So let's flip the conversation a bit. I appreciate that on a tactical sense, maybe you're like, okay, I can take the foot off the gas a little bit for European equities, but is there also a chance of a deep drawdown if the ECB keeps going for a few more 25 basis point rate hikes and holds there?
Of course, there's always a risk to downside, but I don't particularly see a major drawdown in the European equity market, mainly because of the positioning has always been relatively light, and you can still consider that there is a short positioning still that can come into Europe, and considering the relative play looking into US or the emerging markets, Europe still holds in a better shape than US. So if you look into putting all these together, I don't think that there will be a major drawdown in European equities on the blue chip side.
What about this bond market? Yields are higher at the moment, but some of the worst of the pushing higher in yields subsided during the banking crisis. 10-year yields in Germany around 2.5%, a little bit lower than that. Does that seem realistic to you, that is where inflation will be in looking into the long term? Are bonds fairly priced at this moment?
Bond pricing have been all over the place this year, so it's not an easy one to make a statement out of that, and or looking into bond market and making a judgment or their behavior towards the other risky assets like equities. It has been quite mixed, but I don't think it is realistic to assume that will be as low as that it is now. So our expectation that it will be a bit more higher by the end of the year.
So wrapping it all together, where is the tactical play right now? If it's not Europe, where is it?
I think the tactical play is, if you want to stay within equities, is more around finding the sectors. For example, we like communications in US. I think there is a value in European tech sector that has been significantly underestimated or not looked up as much as the US tech. And when we still feel that there will be potential upside on the European banks, even though that there were a lot of stress and worry, fundamentals are very strong, and there was a major sell-off, so this can give it a good tactical entry for the tactical trading positions.
But presumably it's picking and choosing in the banking sector, or is it you could buy the sector as a whole?
It's more around staying on the mid to large size banks, especially not only in Europe but also in US. Now that we've started to see in the US banks earnings as well, and the details of those earning announcements, clearly big banks are taking more advantage. So it applies, I think, the same for Europe.
Okay, Zainab, thank you very much. Thanks so much for joining us. That's Zainab Öztürkoğlu, Deutsche Bank EMEA CIO. Now coming up, belt tightening at Barclays. The bank is cutting jobs in its investment banking group. We'll have that for you next. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Angel Feliciano. Apple sales in India hit a new high of almost $6 billion in the year through March. That highlights the market's increasing importance for the iPhone maker, as CEO Tim Cook is set to inaugurate India's first Apple stores this week. Apple wants to accelerate growth in India, where the company's smartphones and computers have never held more than a small market share due to their high cost. A French court on Monday acquitted Airbus and Air France of manslaughter charges over the 2009 crash of Flight 447 from Rio to Paris. The wreck killed 228 people and led to changes in aircraft safety measures. The three-judge panel ruled there wasn't enough evidence of a direct link between company decisions and the crash. The official investigation found that multiple factors contributed to the disaster. And another sign of mounting pressure on the banking industry. Barclays is responding to a slowdown in deal-making and capital markets businesses by cutting about 100 roles in its investment banking group. The London-based lender already let go of roughly 200 positions from the same division in November. And that is your Bloomberg Business Flash. Danny?
Angel, thank you so much. Let's talk about that story that Angel just mentioned, those job cuts at Barclays. Bloomberg's Tom Metcalf joins us now on it. Tom, this does look like bad news for Barclays investment bankers. The sector of a whole has been bracing for these types of job cuts. How bad is it?
Yeah, exactly. So it's another 100 roles. Had 200 back in November. You know, put that in context, there's a few thousand Barclays investment bankers, so it's not kind of a wholesale cutback, but it speaks to this just general gloom around the sector. We've seen with a few of the US banks already that look, those investment bankers are just not bringing in any business at the moment because there's no deals to be done. And I think this sort of speaks to what we can expect for Barclays results and most of the investment banks ahead. You know, it's going to be another rough period for investment bankers, and you know, I think, as I say, the question for them is probably, will I have a job, rather than you know, what's my bonus going to be or something like that.
No, fair enough. Hey, Tom, you kind of took us there. Barclays first quarter, what are you going to be watching?
Yeah, I think it'd be really curious to see how those traders do on the other side of the investment bank. You know, they've normally been able to sort of counterbalance any sort of disappointing performances among the investment bankers. So that would be critical. But the other thing we're seeing as well is, you know, there's still all this chatter around ex-CEO Jess Staley, and I'll just be curious if the bank kind of, you know, makes maybe another public statement on that, or just sort of keeps a low profile on it.
We were just talking in the break how there's some pressure on HSBC and activist investors. What's going on there, Tom?
Yeah, so you've got Ping An sort of in the background pushing for a big strategy change at HSBC, and effectively as a Hong Kong retail shareholder who's taken a similar view, put in a few special resolutions at the upcoming AGM, which basically effectively reiterate what Ping An wants. And Ping An have come out today and sort of said, hey, look, we will probably vote for these, as you'd expect. And again, I think it just makes the point that there's some very interesting conversations likely to be had at this AGM, and you know, HSBC still has sort of a fight on its hands to persuade, well, certainly Ping An, of the merits of its strategy.
Where does all the talent go, Tom? Like, as we get into earnings, right, and we're going to see the different sections and different areas doing well, and we see the layoffs, etc. Like, where it happens, do they get recycled? Like, is this a hedge fund private equity dream? Like, what do we think the spillover is going to be?
Well, in terms of those job losses we've seen, I mean, that's going to be really tough for all investment bankers, right? Like, you know, they're not going to be, there's not going to be many jobs on the street out there, right, frankly. So it's going to be a tough period in that section. If you're a trader, I think, you know, that's probably an apt description, a hedge fund dream. If you're, you know, making those big bucks, there's still so much money to be had out there, and that's what we're hearing. A lot of the very, very top talent are still getting poached, and it's still a good place to be if you're obviously making the right calls.
We talked about Barclays first quarter sort of coming up. You've got a busy couple weeks also. We got a UBS, we got Credit Suisse coming out in about 2 weeks' time. What are some of the themes that you're going to be watching for U.S. banks as they report this week as we go into European banks?
Yeah, look, the thing I'll be looking out for is what kind of translates over to Europe, right? So, you know, as we look at, say, the Goldmans, etc., how that kind of suggests how Barclays might do, right? Barclays has a very big investment bank, so if the Goldman traders blow it out of the park, A, you'd think the expectations rise for Barclays, and B, sort of the likelihood of them doing well probably increases a bit. But then it's the same for all the banks, right? How are they doing with those higher sort of interest rate margins? JP Morgan came out, had a great story to tell, and be very curious if that translates over into Europe.
Okay, Tom, thank you very much. That's Bloomberg's Tom Metcalf. Now, we only have a few minutes to go until markets close. Quickly, want to get us our last calls. Analyst changes. TeamViewer upgraded by Berenberg, saying that, yeah, they might have had a negative story previously, but they are turning things around, and the market is ignoring them. So now have a target of 21 euros. Fortum, this is the Finnish energy company. This is a call from analysts that power generation has peaked. That means earnings for these types of companies are going to peak. So this specifically comes from the city, downgrading those shares, saying it's now neutral. Finally, RS Group. This one is just a general valuations are good. There were some concerns about management. Those have been addressed. A more favorable risk reward. They say outperform, go and buy it. We'll have the close up for you next. This is Bloomberg.